One top strategist now says your best move is to sell before May and go away. We explain, we debate the call with the investment committee. Joining me for the hour today, Bryn Talkington, Joe Terranova, and Jenny Harrington, both of whom are here at Post 9. Let's check the markets here. Somewhat muted action. Dow's having a good day, led by Caterpillar today, but technology is lagging. Consumer discretionary is a bit weak. The VIX is at 18. Oil is at 81. All right, Jenny, so we're waiting on tomorrow morning. They just laid out for you what Goldman Sachs is talking about in terms of the print and what it could mean for stocks, and I'll go through that again in just a minute. But are we waiting on that in the morning, and that's the biggie?
I think so, but I also think it's a lot of what we were talking about when I was on Thursday, which is starting to move away from inflation. We know that it's cooling. We know that it's going to be persistent, right? We know it'll be in the 6% range still, which is higher than the Fed wants. And I really think that what's going to eclipse everything else is earnings. So while we're looking for that, I think what comes out of earnings is going to be much, much more important and much more telling, because it really is time to start looking forward. It really is time to start saying, when are earnings going to recover? What's 24 going to start to look like? I know that's early, but I think that's where the investor lens is starting to head.
So, Joe, Sarah went through what Goldman Sachs just put out, excuse me, before we came on the air in terms of the kind of print that you may get and then the kind of reaction you may see in the stock market. So let's recall February was 6.0, okay, 6.0% on headline. They say if you get greater than 6, you're going down 2%. On the S&P. Between 5.2 and 6, you're going down 1 to 2%. If you get between 4.6% and 5.1, you get 50 to 100 basis points of a rally in the S&P, and then less than 4.6, the outlier read, you get a more than 2% rally. You want to take that on at all?
I mean, it all seems very logical. Statistically, I don't know the accuracy of it, but certainly directionally, it seems to make sense. I think we're about to go into a hailstorm where there's just going to be an abundance of data that's going to come at us, from inflation tomorrow to retail sales on Friday to the earnings reports that are going to begin on Friday through the remainder of the week and the intensity of the 24th to the 28th. It's a hailstorm. We're going to see if there's sunshine on the other side of the hailstorm or not. I still look overall at the market, and I still see charts that look pretty good. I see moving averages that are actually turning up, which doesn't seem logical given where a lot of the research notes are right now and how positioning is.
Some, Bryn, have tried to get a little more positive on the market of late, but Wells Fargo's Chris Harvey is not one of them, and he's not waiting around either for what the print is tomorrow. He says sell before May and go away. I referenced that at the top of the show here. We are within spitting distance of our 4,200 S&P target. He says now shifting direction. Expect a 10% correction in the next 3 to 6 months, a front-end inversion, a 7% year-to-date run, and a banking crisis that will likely take an economic toll triggered our reversal. You want to weigh in on this Harvey call? It's time to sell now. Don't wait for May.
Well, that's definitely a dour outlook. I mean, let's look at seasonality. First of all, the two best months of the year are April and December. We got, though, in the first quarter, the information, the NASDAQ was basically up 20, and we don't need to go through all the tech stocks that are up 30 to 70% year to date. And so I think in terms of the mega caps tech, which is still so much of the S&P, we have pulled forward so much of 2023's gains. So I think that makes sense, right? To say, don't wait till May. We have pulled forward in general. I think there's areas like energy, maybe some staples. There's other areas that have not participated. And so I think this is more about tech than the broad market. But I also wanted to put a note on CPI. I think Goldman's note is interesting. But this is actually pretty simple math. CPI right now is at 6%. And for the viewers, it really just looks at the last 12 months and then adds those together. March of 2022, May of 2022 and June had prints of between 0.9 and 1.2. So, Scott, those are going to start dropping off over the next 3 months. So even if CPI over the next 3 months grows at 0.4 month over month, by June, inflation will be cut in half to around 3.5%. And so to me, that's a very bullish narrative in terms of there's lots of cross currents, but I do think inflation is going to drop handsomely just because we're going to kick off those backwards numbers, which I don't really think people in general understand the simplicity of that. So I definitely think it's more of a bullish note to kind of do a counter against Harvey's bearish tone, which may be accurate,
okay,
but I think it's going to be more complicated than just sell in May. I think it's going to be more about sectors and positioning than just sell everything and come back.